Hello and welcome to Impact Tuition. In this lesson, we will discuss IAS 36, Impairment of Assets. Upon completion of this lesson, we will be able to define an impairment loss, list the circumstances which may indicate impairment to assets, describe a cash generating unit, explain the basis on which impairment losses should be allocated, and allocate an impairment loss to the assets of a CGU. Let's begin. Objective of IAS 36. The objective of IAS 36 is to set rules to ensure that the assets of an entity are carried at no more than their recoverable amount. This is the objective of IAS 36. After we have depreciated an asset, it is carried at their carrying amount in the statement of financial position. But certain indicators may show that the asset is less in value than the amount we have in our books. So when that happens, an impairment review would be carried out. Now, when the impairment review is done, the recoverable amount will be compared to the carrying amount that we have after taking care of depreciation. And if the carrying amount is greater than the recoverable amount, the asset will be written down to the recoverable amount. And the difference between the recoverable amount and the carrying amount is the impairment loss. So IAS 36 is there to ensure that the assets of an entity are carried at an amount that reflects their true value. Right. Now let's look at impairment. An asset is impaired if its recoverable amount is below the value currently shown on the statement of financial position. Currently shown on the statement of financial position. So we are talking about the assets current carrying amount. So like I explained earlier, an asset is impaired if the recoverable amount is below the value currently shown on the statement of financial position, which is the asset's current carrying amount. What is the recoverable amount? The recoverable amount is taken as the higher of fair value less cost to sell fair value less cost to sell, which is the same as the net realizable value, and value in use. So an impairment exists if the carrying amount is less than the higher of fair value less cost to sell and value in use, which represents the recoverable amount. We will explain each of these. Measurement of recoverable amount. We'll start with the measurement of fair value less cost to sell. The fair value less cost to sell can be measured by way of a binding sale agreement, and then the current market price less the cost of disposal. From a binding sale agreement, we can actually determine the cost at which the asset will be sold. If there is no sale agreement, we can look at the current price of similar assets in the same condition and the cost of disposal. So we take the current price of similar assets and then we estimate the cost of disposal, take it out, and the remainder will be our fair value less cost to sell. So we can determine the fair value less cost to sell from a binding sale agreement or from current market price less the cost of disposal. Measurement of value in use. The value in use is how much an entity would make from the continued use of the asset. So instead of selling it, if we decide to use it, what will be the future cash inflows and outflows from the use of the assets and then its ultimate disposal? When we've made an estimate of these inflows and outflows and amount at its disposal, we will apply an appropriate discount rate to these cash flows, and the resulting amount is the value in use. So for value in use, it is simply an estimate of future cash flows so this is both inflow and outflows to be derived from the continued use of the asset. And its ultimate disposal, and applying a suitable discount rate. When we've determined these future cash flows from the use of the asset and its ultimate disposal, we apply a suitable discount rate to these cash flows, discount them, and what we will have is the value in use. So when we've had our value in use, we would then compare the fair value less cost to sell with the value in use and pick the higher of the two. Then we will compare, and that becomes our recoverable amount. Then we compare the recoverable amount to the carrying amount of the asset. If the carrying amount is more than the recoverable amount, the asset is impaired, and the difference between the two becomes our impairment loss. Right. Let's look at a simple illustration. We have three assets, A, B, and C. In Ghana cedis, the carrying amount of asset A, 100,000, asset B, 150, asset C, 120. The net realizable value, which is the same as the fair value less cost to sell, we have 110, 125, and 100. The value in use of asset A is 120, asset B 130, and asset C 90. So we are to determine the recoverable amount and then calculate the impairment loss of each of the three. Let's start with the recoverable amount. All right. The recoverable amount is the higher of NRV and the value in use. So for asset A, the higher of 110 and 120 is 120. For asset A, 120 is a recoverable amount. Asset B, recoverable amount is the higher of 125 and 130, which is 130,000. For asset C, a recoverable amount is the higher of 190. So a recoverable amount is 100, which is the net realizable value. We are done with the first part. The second part of the question is to calculate the impairment losses for each of the assets. An asset is impaired if the carrying amount is greater than the recoverable amount. Asset A has a carrying amount of 100 and a recoverable amount of 120. Since the carrying amount is lower than the recoverable amount, there is no impairment loss. So impairment loss for asset A is nil or 0. We come to asset B. The carrying amount of asset B is 150. Recoverable amount is 130. It is obvious that the carrying amount is higher than the recoverable amount. So we need to write down the value of the asset to the recoverable amount. And the difference is 20,000. So for asset B, our impairment loss is 20,000. Asset C, carrying amount is 120. Recoverable amount is 100,000. Since the carrying amount is higher than the recoverable amount, the difference between the two becomes our impairment loss. And impairment loss is also 20. So this is a simple illustration of how to determine the recoverable amount and then the impairment loss of an asset. Indicators of impairment. Certain indicators will let us know that an asset has been impaired. So IAS 36 requires that at each reporting date, an entity must assess whether there are indications of impairment. Now, these indications may be derived from the entity itself or from external sources. We have two sources of indicators: internal and external. Let's look at the internal sources of indicators of impairment. 1, there is evidence of obsolescence or damage to the asset. An example of this is if, as a result of technological advancement, the asset is no longer relevant, or the asset has been involved in an accident, say a vehicle that has been involved in an accident. Obviously, the true value of the asset will be less than the value of the asset in our books. So, the first internal source of evidence of indicator of impairment is if the asset is obsolete or evidence of physical damage to the asset. Changes in the way the asset is used have occurred or imminent. Changes in the way the asset is used have occurred or are imminent. Maybe there is this one asset that we were using continuously for production, and we've stopped using the asset continuously, maybe once in a while. So there's a drastic change in the way the asset is used, and that may be an indicator of impairment. Now, when there is evidence that the economic performance of an asset is or will be worse than expected, evidence that the economic performance of an asset is or will be worse than expected. This is also an internal indicator of impairment. So if an indicator of impairment exists, then an impairment review must be performed. Let's move on to the external indicators of impairment. External indicators of impairment. The asset's market value has declined more than expected. The decline in the market value of the assets than expected. Changes in technology. Markets or the legal environment. Have had an adverse effect on the entity. Changes in technology may make our current technology obsolete or our current assets obsolete. So, it is an external indicator of impairment because it comes from the external market, or there is a new law that bans the use of our current asset. And the effect of this is adverse on the entity. So something like this is obviously a source of impairment. If the new regulation bans the use of the asset we currently have, it means we no longer can use it. And so the value of the asset, will be far less than what we have in our books, and that indicates impairment. Interest rates have increased. Thus, increasing the discount rate. Used in calculating the asset's value in use. So these are the external sources of, or the external indicators of impairment. Annual impairment review. We've mentioned that where the indicators of impairment exist, the entity has to undertake an impairment review. Where there is no indication of impairment, then no further action need to be taken. Where no indication of impairment, no further action. But where there is indication of impairment, then there has to be an annual impairment review. Where there is indication of impairment, carry out an annual impairment review. So the review is where we get the recoverable amount, which is the higher of value in use and fair value less cost to sell, and then we compare that with our carrying amount to determine if the asset is actually impaired. Now, the exception to this rule is goodwill acquired in business combination, an intangible asset with an indefinite useful life, and an intangible asset not yet available for use. We have a video on intangible assets. You can refer to that video to know more about impairment of intangible assets. IAS 36 requires annual impairment reviews of these assets, irrespective of whether there is any indication of impairment or not. Whether there is an indication of impairment, irrespective of that, you have to carry out an impairment review for goodwill acquired in a business combination, an intangible asset with an indefinite useful life, and an intangible asset not yet available for use. Recognition and measurement of an impairment. Where there is an indication of impairment, an impairment review should be carried out. In this review, we'll calculate recoverable amount. Recoverable amount is calculated. The assets should be written down to recoverable amount. Asset is written down to the recoverable amount. The impairment loss should be recognized in the statement of profit or loss. So, we first have to calculate the recoverable amount. Then the asset is written down to the recoverable amount, and the impairment loss is recognized immediately in the statement of profit or loss. There's an exception to this. The only exception to this is if the impairment reverses a previous gain taken to the revaluation surplus. I will explain. The impairment should be immediately recognized in the statement of profit or loss. Now, the exception is that if the impairment reverses a previous gain taken to the revaluation surplus, the impairment loss will not be recognized in the statement of the statement of profit or loss. In this case, the impairment will be taken first to the revaluation surplus, and so disclosed as other comprehensive income until the revaluation gain is fully exhausted. Then any excess is taken to the statement of profit or loss. So if we have already, let's say we've previously recognized the gain in a revaluation surplus account, the impairment on the asset will be used to reduce the revaluation gain or the revaluation surplus until it is exhausted. Then any excess will then be recognized in the statement of profit or loss. Right. We'll take this illustration to test our understanding of this. An entity owns a property which was revalued to 500,000. revalued to 500,000 Ghana cedis. An entity owns a property which was revalued to 500,000 Ghana cedis on 31st March 20x3 with a revaluation gain of 200,000 Ghana cedis being recognized as other comprehensive income and recorded in the revaluation surplus. At 31st March X5, the property had a carrying amount of 460,000. But the recoverable amount of the property was estimated at only 200,000. We are required to calculate the amount of impairment and then explain how this will be treated in the financial statements. Right. Let's go over the illustration. The property was revalued to 500,000, leading to a revaluation gain which was recognized as other comprehensive income in revaluation surplus of 200,000. The carrying amount of the asset at the end of the year is 460,000, and the recoverable amount estimate is 200,000. We are required to calculate the amount of impairment and then explain the treatment in the financial statements. All right. Recoverable amount is the higher of the fair value less cost to sell and the value in use, which we have been given to be 200,000. The carrying amount of the asset is 460,000, so our impairment is equal to 460,000 minus 200,000, which is equal to 260,000. This is our impairment. Now, how will this impairment be treated in the financial statements? Now, of this 260,000. 200 is debited to the revaluation surplus to reverse the upward revaluation. So we have a revaluation gain of 200,000, which is in the revaluation surplus account. So we are going to debit the revaluation surplus account with 200,000 to reverse the upward revaluation, and then the remainder will then be charged to the statement of profit or loss. So the treatment will be to debit revaluation surplus with 200,000 and then debit the profit or loss with 60,000. Revaluation surplus 200,000, profit or loss 60,000, and then we will reduce or write down the asset. They will credit the asset or the property with 260,000 to write down the value of the asset from 600,000 to our recoverable amount of 200,000. And this is how the impairment loss will be treated in the financial statements. Reversal of an impairment loss. We must understand that the calculation of impairment losses is based on predictions of what may happen in the future. There are times when actual events turn out to be better than predicted. If this is the case, the recoverable amount is recalculated and the previous write-down is reversed. Impaired assets should be reviewed at each reporting date to see whether there are indications that the impairment has reversed. So review impaired assets at each reporting date to see whether there are indications that the impairment has reversed. A reversal of impairment loss is recognized immediately as income in profit or loss. If the original impairment was charged against the revaluation surplus, it is recognized as other comprehensive income and credited to the revaluation surplus. The reversal of impairment loss is recognized in profit or loss as income. Now, if the original impairment is tied to revaluation surplus, the reversal is recognized as other comprehensive income and credited to revaluation surplus. We must note that the reversal must not take the value of the asset above its depreciated historical cost. The reversal must not take the value of the asset above its depreciated historical cost. This means that the amount it would have been if the original impairment had never been recorded, the depreciation would have been charged in the meantime. The depreciation that would have been charged in the meantime must be taken into account. And then the final thing to note is that the depreciation charge for future periods should be revised to reflect the changed carrying amount. The depreciation charge for future periods should be revised to reflect the changed carrying amount. So these are things to note whenever there is an impairment, whenever there is a reversal of an impairment loss. Indicators of impairment reversal. I think this will be the last thing we'll look at, and then we bring our discussion to a close. Impairment of cash generating units will be in a separate video. Indicators of impairment reversal. External indicators. Increases in the assets market value. Favorable changes in technology. Favorable changes in technology, the market, economic, or legal environment of the business. Where there are decreases in interest rates, these are basically the opposite of the external indicators of impairment. So if there are improvements in these indicators of impairment, then we need to reverse the impairment we calculated, and that will lead to the reversal of the impairments we have already recognized using these external indicators. Internal indicators of impairment reversal. Favorable changes in the use of the asset. Improvements in the asset's economic performance. Internal indicators of impairment reversal, favorable changes in the use of the asset, and improvements in the asset's economic performance. We'll look at cash generating units and how impairment is calculated for cash generating units. And we'll do that in a separate video. Thanks for watching, and don't forget to subscribe to the channel and share with friends who would need these videos as well. Thank you.